Almost every number that landed this week gave the Federal Reserve room not to tighten further. Inflation cooled, prices at the factory gate didn't move, consumer confidence fell sharply. Then, on Thursday, the US government borrowed money for 30 years. The price? 5.216%, the highest auction yield since 2001. The Fed controls the overnight price of money. It doesn't control what investors demand to lend for 30 years. And this week, those two parts of the system appear to be pulling apart. Here's why we think that matters more than almost anything else this week, plus a labour market that still can't agree with itself, and a shipping lane getting more dangerous at exactly the moment its map is nearly finished. Episode 6: Yield Instability, Signals over Narratives. New claims for unemployment benefit rose to 209,000 this week, breaking a run of 3 straight weeks below 200,000. On its own, that's still a low number by any historical standard, but it's moving the wrong way at the same time the slower jobs survey has been telling a weaker story for a month. We flagged this divergence last week as an open question. It didn't resolve. It got muddier. South Korea's stock market, which we've been watching swing violently on leveraged bets in its two biggest chip makers, has now swung the other way. It's up around 23% from its late July bottom. Same mechanism, same two stocks, opposite direction. But something potentially more important happened elsewhere. Nvidia has reportedly cut back how much it's prepared to guarantee for one of OpenAI's giant data center projects in Ohio. A figure once discussed at as much as $250 billion is now reportedly below $120 billion. That's worth watching. Because this isn't a commentator asking whether the AI build-out has become too expensive, it's actual money becoming more cautious about how much risk it's prepared to carry. And if long-term capital remains expensive, that question won't stop with Nvidia. Consumer sentiment fell sharply in August. The University of Michigan's preliminary reading came in at 51, reversing July's improvement. We said last week that improvement needed testing. It just failed its first test. But here's the more interesting contradiction. Consumers now expect higher inflation over the next year than they did a month ago, even as the official inflation numbers cooled. Official inflation is looking backwards. Expectations look forwards. And right now they're pointing in different directions. Iran and Oman are reportedly close to finalizing a shipping map through the Strait of Hormuz. The agreement would establish safe routes and a joint monitoring arrangement between the two countries. That is real progress, and it's worth saying so plainly. But in the same week, tankers were attacked while transiting the strait. Diplomatic progress and rising attacks are happening at the same time, not one after the other. And we're not going to pretend the map settles the water underneath it. Gold pushed through $4,400 an ounce this week. The dollar remained below its 100-point marker, while Rose's pressure around Hormuz continued. But the number that matters most this week came from the bond market, 5.216%. That's what investors demanded to lend the US government, money for 30 years. The highest auction yield since 2001. And importantly, investors did turn up. This wasn't a failed auction. The government could borrow the money, it just had to pay more for it. That's the distinction. And here's the tension. Soft inflation said the Federal Reserve has room not to tighten further. Weak consumer confidence said the economy is losing momentum. But the long bond said, not so fast. The Fed sets the overnight rate. The market sets the price of 30-year money. And this week, those two signals moved apart. The S&P sits at a record in the middle of that disagreement. That is the tension we're watching. The master signal at the moment is yield instability. The long end won't follow. The Federal Reserve can stop tightening and long-term borrowing can still become more expensive. That's important because 30-year money doesn't stay inside the Treasury market. It reaches mortgages, government refinancing, corporate borrowings, infrastructure, AI data centers, and eventually the price investors are willing to pay for equities. Confidence is medium because we don't yet know whether this is the beginning of a genuine repricing of long-term risk or one auction cycle making a lot of noise. Consumer fracture stays live underneath it, not retired. Its evidence didn't get clearer this week, it got muddier. On the observatory, we've been updating this. It will be going live properly over future weeks. So I'm just going to move through these quite quickly. So thanks for listening. MoneySpider, watching the financial web. Systems matter. Systems leave signals. Until next week, keep watching the web.